This is Capital Ideas TV. Coming up, a special lithium episode. The CEO of Nano One Materials, making lithium-ion batteries cheaper and more powerful. The head of Desert Lion Energy, newly public and stockpiles to sell. Neo Lithium CFO on financing, milestones, and valuation. Hello and welcome to Capital Ideas TV. I'm Mark Bunting. Talk to anyone in the auto industry and they'll tell you that electric vehicles are the way of the future. Technologically speaking, they're ready for mass market rollout today, but there's one thorny issue holding back their widespread adoption, and that's the sticker shock consumers get when they read their price tags. What makes EVs so expensive is the sky-high price of lithium, a crucial component in the batteries. It's a problem only expected to get worse with time. Demand for the key components of next-generation battery systems are expected to soar in the coming years. Automakers' appetite for lithium stock will be nearly 8 times the supply on the market by 2026 if current trends hold up. Cobalt will face a big supply crunch too. One of the main hurdles is the pickiness of battery makers. Their current fabrication methods require higher-grade lithium hydroxide. It's both tougher and more expensive to produce. As a result, electric vehicle batteries cost as much as $350 per kilowatt hour. That figure will need to fall below $100 for EVs to become a more economic alternative. Nano One Materials is up for the challenge. It believes it's pioneered a way to bring the cost of batteries down sharply while boosting their output greatly. The company has patented an industrial process for making cathodes using cheaper and lower grade lithium carbonate. The process mixes raw materials such as lithium and nickel in a solution before they're fired together in a kiln. This causes them to combine more purely and with less need for additional processing. The end result is a streamlined process that takes hours rather than days and significantly cuts the manufacturing costs of cathodes. This process also helps improve the lifespan of batteries. Because the raw materials combine more purely, their power output is much greater and their decay much slower. Nano One has found that their cathodes help double or even triple the capacity of batteries over 500 cycles. This means electric vehicles could travel farther per charge and last longer before needing to be replaced. Nano One believes its manufacturing process can slash the cost of battery cathodes in half. And if it were widely used, it could also make use of a much wider stock of lithium, which would help alleviate supply concerns. The company has been proving the viability and scalability of its technology for the past several months. Now it's ready to strike deals with industry partners to take it mainstream. CEO Dan Blondal explains his go-to-market strategy for this year. Dan, electric vehicle batteries are too expensive, but you have a way at Nano One to bring the cost down and to increase the performance of the battery. So in simple terms, how do you do that?
So we're in the business of assembling the raw materials that go into a lithium-ion battery, the stuff that stores the lithium ion. So lithium, nickel, manganese, cobalt, we assemble those into a value-added material. And essentially it's a manufacturing technology to do that. And then that further enables savings in the battery that can lead to lower cost batteries, smaller batteries, higher performance type batteries.
Now, tell us about some of the pilot programs you've done, other ones you're planning, and some of the milestones you've hit and plan to hit.
So the biggest milestone we hit last year was building a demonstration pilot plant. So we started the project about 2 years ago. This time last year, we had an empty warehouse, as I was telling you before, and we had it built and operating by June. And so that's a very big milestone. It brought us credibility both on the markets and in industrial circles as well. So we're starting to talk to some of the sort of majors in the space, be they way upstream in the mining space or downstream into the battery and vehicle space as well. So there's interest really from all levels in what we're doing.
So what does the model look like eventually? Do you plan to license your technology, and who would be your partners and your clients?
Yeah, so that's correct. It's a licensing technology, a licensing platform that we're pursuing. So we have an engineering package, which is the designs for a plant. We have the technology package, which is the patents, the IP, the know-how, the people, and those are the two things we bring out, going to market to the space. And the typical company would be someone in the specialty chemicals space, so either in the cathode space already, or they want to get into it.
So when you pitch Nano One to, say, Bay Street or a potential client, How do you play up what seems to be a very disruptive way of doing things in terms of electric vehicle battery manufacturing compared to the current way?
So the way that, I mean, I have to explain the current way to kind of get into it. Without getting too technical, they take the lithium, nickel, manganese powders, and they crush and grind and mill them together. So you get a mixed amount of powders, and then they actually put it in a furnace. It's a kiln for all extents and purposes. It drives it up to 800 or 900 degrees, and slowly, as that heat seeps into everything, the atoms of lithium, nickel, manganese, and cobalt all diffuse into together and make this crystal structure that allows lithium ions to be inserted and extracted during the charge and discharge of the battery. So that's how it's currently done. We do it chemically. So we assemble lithium, manganese, and cobalt all chemically in an aqueous solution, atmospheric pressure. It's pretty benign chemistry for all extents and purposes. And in doing so, it enables us to structure the materials more robustly. We're able to get everything really intimately mixed before we go to the furnace, so we don't fire as long in the furnace. And we can add all that extra pixie dust in there that makes it either operate at high temperature or have greater longevity cycle to cycle. We can add all that in so we have value-added cathode materials that come out at the end.
And you have some patents on this technology?
Yeah, so we have 4 patents out right now. We've got about 30 more in the pipe around the world. That's from about 11 or 12 different patent families. And we should see a couple out this year as well. So I hope by the end of this year we'll be at 6 or 7 patents on granted to Nano One.
Right now you're pre-revenue. When do you expect to see revenue, and then when is profitability, or is that too hard to say right now?
Well, the revenue models can go a couple different ways. Partly because we're talking to tier 1 automotive suppliers and automotive companies about next generation batteries, which are quite a ways out. We're building the materials that go into those batteries. But we're also talking to chemical companies about licensing models. If those kick in this year, it's probably a 2-year turnaround to site it and build it and put it in place. But there would be advances on those licensing revenues that we could see as early as this year. And so that would be as quick as it's going to come. But we've got some milestones to crack there, and we have to have the engineering plans in place. But we're working actively with chemical companies on that process right now. And
lastly, it seems as if a number of investors have discovered your story. As we sit here, yes, your stock has just taken off. What do you think has triggered that?
Well, there's a number of things that we believe is triggering that. One is that we have a material in particular that we've been working on. We call it the cobalt-free high-voltage spinel. So it consists of manganese and nickel, but there's no cobalt in it. And we've been working on this for about 1.5 years, 2 years, and we hit some milestones in December and in January. Meanwhile, the cobalt market's been going crazy. It's been tripled in price in the last couple of years. Right. And so we've always seen this as a hedge. We're working on materials with cobalt and without cobalt. But the ability to take this cobalt-free material and stick it into these next generation solid-state batteries is a lot of blue sky there, because it could be the next kind of wave of materials that goes into high-density, safe, non-flammable batteries. And I think the market's finally starting to pick that up because of the way that the cobalt prices have been going up. So they're just hearing the story.
So we finance top-tier companies in the medical cannabis industry in exchange for a royalty. So I love the royalty model. I think it works perfectly for this industry at this time. Debt is largely not available in the US, and equity can be massively dilutive. And the reality is every company in California and most states right now is a startup company. So we offer a very attractive, either a complement or an attractive alternative to debt or equity, which really aligns our financial interests with the interests of the people that we invest in. So when they're successful, we're successful, and the more successful they are, the more successful we are.
Timing is everything when it comes to the mining business. Projects that are attractive one day might be worthless months later due to the cyclical nature of the industry. Well, the timing is very right for lithium right now, and likely will be for the next several years at least. That's what makes Tim Johnston's timing all the more impressive. His company, Desert Lion Energy, is the owner of a massive tract of land in the outback of Namibia. It's a lithium-rich property with a history of producing high-grade lithium. The resources there are at shallow depths, making them easy to mine. And the project already has access to power, water, roads, and a port. The previous owner of the mine didn't see the value and passed it off to Desert Lion. Now, this previous owner held the property before lithium was a key component of batteries. They left behind large stockpiles of lithium that are now worth thousands of dollars per ton. Desert Lion is picking over those leftovers, turning them into lithium concentrate and selling them to fund the construction of its mine. CEO Tim Johnston takes us through his three-phase plan to unleash the project's true potential and the progress the company is making. Tim, last time you were here, you talked about Desert Lion's three-phase plan out to 2020, starting with the existing stockpile. So where do we stand there? I understand you're very close to making some sales.
No, absolutely. So in December of 2017, we started production from our run-of-mine stockpiles. We have two parts of that operation. The first part is a sorting plant. So where we currently stand today is we're mining 3,000 tons of material per day. We crush and screen to size that material, and then we process it through 3 XRT and NIR sorters to produce a 2% lithium concentrate. Currently producing about 500 to 600 tons of concentrate per day at the moment.
And you're saying that you can sell this over the course of 12 months or so? And how much revenue are we talking about here, estimated?
Correct. So we have the sorted concentrate. We also have this float concentrate that will start production in late Q2, early Q3 of this year. So combining those two activities together will generate approximately $15 to $20 million in free cash this year after expenses.
And then remind investors about phase 2 and phase 3.
Yeah, so the concept is that in parallel to completing the phase 1 operation, which is the operation from the stockpiles, we're continuing to develop the resource and engineering for phases 2 and 3. Phase 2 is the mining of the in situ material and larger scale concentrate production, with target production of 250 to 300,000 tons per year. And then phase 3 is ultimately a lithium carbonate plant, which will be located down in Walfish Bay, producing 25,000 tons a year of lithium carbonate.
You talked last time about being in talks with potential offtake partners to take your production. So where does that stand?
So we signed an offtake deal in November of 2017 with a group called Jinquei. Jinquei is an existing lithium carbonate producer in China. They have 2 lithium carbonate plants, 2 concentrators. They provided a $4.5 million US prepayment facility to get us into operation, and they committed to buying everything we produce from phase 1.
As far as your cash standpoint, you've done a few private placements. How much cash do you have, and is all of that earmarked for the expansion?
Correct. So last year we raised $27 million Canadian. We currently have $13 million Canadian on our balance sheet. That money is earmarked for both the expansion but also the continuation of the exploration program, which will support the MRE release in Q2 this year.
One of the appealing aspects, Tim, of your mine in Namibia is that you have existing infrastructure, which you've discussed before. I'm just wondering, because a lot of it had been sitting around a long time, is some of it aging and do you have to invest in that?
So the benefit of the environment in which we're in is the infrastructure is actually in very good condition. We have invested to upgrade our access road. We built an additional 18 kilometre access road to provide support for the current operation. The rail infrastructure is in very good condition. We've put in our own water infrastructure, and the existing power infrastructure is also in very good condition. So we don't see any real issues associated with aging assets associated with infrastructure.
Desert Lion Energy is now officially a public company on the Venture Exchange, so make the investment case for investors, because there are a lot of companies developing lithium mines around the world, hard rock, brine, and so on. How are you different? How are you different from your peers, and why should an investor buy the stock of Desert Lion Energy?
Absolutely. Desert Lion is a different company. We are an operating lithium company. There's only 2 operating lithium assets on the Toronto Stock Exchange today, and we're one of them. So one of the key differentiators is that aspect. The second is our jurisdictional benefits. So if you look at where lithium assets are located around the world, they can be either in high-cost jurisdictions or jurisdictions with high degrees of political uncertainty. We're in a very good jurisdiction from a political stability perspective, but it's also a low-cost jurisdiction. So we're set up not just to produce now from the short-term production of our stockpiles, but long-term with good support from the government, the community, and also having good economic fundamentals which will support low-cost operations for years to come.
Right now you walk inside a truck and you see multiple devices. You see a fleet management device, you get a 2-way radio, black box, tablet of some sort, front camera, $6,000 to $10,000 worth of equipment. We're shrinking down to less than $1,000 in one device. The change in the cabin is just dramatic. It's just much, much safer for the truck driver to be able to use one device. Really what we're doing is we're creating a new environment and a new technology that has not been seen to date in the market.
There's nothing like a little healthy competition to keep management teams working hard. That's what's playing out in the Argentinian outback between rivals Neo Lithium and Lithium Americas. Both companies are developing promising lithium mines in the region's lithium triangle, and so far Neo Lithium has got the edge when it comes to shareholder value. Here's a look at the 6-month share price performance of Neo Lithium in blue and Lithium Americas in red as of mid-February. It was a pretty tight contest through December, but then Neo Lithium started to pull away, and it's managed to hold up better amid a modest pullback across the lithium industry as of late. Neo Lithium shareholders also enjoy a little more bang for their buck. The price-to-book value of the company's shares remain lower than that of Lithium Americas, though the gap has been closing. So investors are spending less money for a greater return, relatively speaking. Some promising updates from Neo Lithium's third quarter mining project are driving that outperformance. In December, the company lowered its capital expenditure program by nearly $100 million, putting it in line with peers. Then in January, Neo Lithium announced positive drilling results that confirmed mineral resources further down its deposit. More results are expected in the coming weeks, with Neo Lithium ratcheting up its drilling efforts. CFO Carlos Vicens takes us through the drilling results and a few milestones and what they mean for the promise of the third quarter project. Carlos, Neo Lithium recently came out with its preliminary economic assessment, and the key thing there was that your capital expenditure is likely going to be about $100 million less than you expected. So what was the significance of that, and how much do you need to raise, and where do you stand on that?
Sure. So the original capex was $590 million plus or minus, and the new capex is $490 million. The reason that the capex went down $100 million is because now we're building the ponds on top of the salar. When we put out the press release with a PEA, we just ran out of time, and we didn't get to the point where we analyzed the cost of those ponds. Now, those ponds, in general, and all the other competitors within the region are built on top of the salar. So this is nothing new. However, we wanted to test some of the other areas in the alluvial cone, and we put our first pond build-up there. When we looked at the trade-off between the ponds getting built on top of the salar and an alluvial cone, we saw that it was about $100 million difference. That is a very big difference, and we decided to build our ponds there. And the reason for that is because now you're essentially, whatever movement of earth you're doing on the alluvial cones, and the alluvial cone, remember, it's in an angle. It's about 3 or 4 degrees, so the more you get into alluvial cone, the more movement of earth, and that's why we're saving that much money. It's about 1,000 hectares of pond, so it's not a small chunk of change when you talk about the movement of that. Now, the PA was very important for us. I believe that was one of the most critical pieces of news that we put out last year. Prior to that, we had the resource calculation, was pretty big. And one of the main aspects of our PEA was that we were able to deliver a very large PEA production of 35,000 tons, but at a very low cost of about $2,800 US per ton. Now, the significance of that is that we're going to be one of the lowest cost producers, if we were producing today, at $2,800. And the reason for that is the high grade that we have in our resource, and also the low impurity content. Because of those two, we're able to have that type of low cost. We're going to continue to try to lower that cost through other analysis that we're doing today, but that will be in the future.
And let's get back to the financing. You still need to come up with $490. What's that process like, and who are you talking to? Obviously, you're not going to give me names, but what's that process as it goes forward?
Well, we've been working on that even prior to the PEA. And one of the issues we had at that point was that we didn't have a PEA, and people wanted to see a third-party report to see, well, how much does it cost? How much money do you need? Now that we have that report, we published it last year at the end of October, and then the report itself was delivered and public to everybody in December. So we only had it for a couple months. Now we have had more in-depth discussions with all kinds of parties in the value chain. We're talking about companies like the OEMs and all the way to strategics. What are we trying to do? along this year, we're doing our feasibility all of this year. It's a lot of work, a lot of money that we're spending into the project, and we want to bring in a partner in order to work that feasibility with us. Will that partner bring in the entire $490 million? Would it bring in a portion? That is something we're discussing, but we're trying to bring one partner, hopefully one, that will get us very close to that $490 million. How that finance is going to look like is difficult to know. I mean, it could be something where you joint venture at the project level and you're carried to production, or there's more something like you sell an offtake agreement and they're able to finance part of the project by debt and equity. So those are the two major blocks that we're looking into, and the board and management are looking into several of those aspects today to see which is better for the shareholder. That's essentially it.
You touched on feasibility. Where does the company stand there, and what are some of the milestones that investors can look forward to?
Okay, so the milestones this year are by end of Q1, we'll be able to introduce our construction permit. That is a very important part of our feasibility move into construction. Why? Because at that point, at the end of Q1 of this year, we will have a project that is completely and utterly, I would say, with all the permits in place, let me put it that way. And all we would need is, of course, the money to build it.
Right.
But that is very important. So that is something that coming up at the end of Q1. End of Q2, we will have a new resource update. And the resource update is based on what we did last year, about April, end of April last year. We're now drilling almost double the amount of platforms that we did last year. But not only double the amount of platforms, but we're only drilling 2, 3, even 4 times deeper than we did last year. We have very good results, and those will be coming out. In fact, in and around PDAC, you will see some results. And then after that, you'll see continuous results on drilling, and hopefully by Q2 of this year, we'll have a new resource. After that, we'll have flow rates and pump rate results along the way. Also, we are going to build, and we're building today. We already have 3 ponds on the alluvial column, but we're building 3 ponds of 1 hectare each, which is essentially 3 times as bigger as the ones that we have now, on top of the salar, and we'll be also evaporating on top of the salar. So those results were coming out. So there's a lot of news that are coming out, and the pilot plant is being built today, being built as we speak in Chile. That will get in place, and we'll also be able to test that brine that is being currently evaporated in our salar through that pilot plant.
Now, speaking of Chile, let's broaden out and look at the lithium sector a little bit more. SQM recently struck a deal with the Chilean government whereby they're allowed to produce more lithium in the years to come. So what's your overview and the company's overview of supply and demand and price in the next few years?
Well, I wish I knew exactly the answer to that. I mean, it's very difficult. And the reason I say is because you got 2 types of producing resources. You have the brine resources, which are not many and are low cost. And then you have the hard rock, which are there are several of those. In fact, there are like half a dozen or a dozen of them that are currently being built or in production in Australia and 2 in Canada. So there's a lot more of hard rock than lithium brine assets. The problem with the hard rock is more costly to produce. In fact, the lowest cost on the hard rock is about $5,000 to $6,000 per ton. And the high end is above $10,000 per ton. Remember that when I spoke about our cost of production is about $2,800. So you can see the big difference in discrepancy. So when you talked about pricing, well, in my own view, price will never be lower than the highest cost of that hard rock. So that would be in and around $10,000. Now, all that's predicated on strong demand. And where does that demand come from? Well, it will come from what everybody understands as electrical vehicles. Every day in the newspaper, magazines, wherever you read, there's a new car manufacturer, an OEM, saying that they're going to go even beyond what they want to go in terms of how many cars they're going to build. To give you a rule of thumb, for every % penetration in the car electrical vehicle market, 1% of penetration is roughly around 50,000 tons of lithium carbonate equivalent. So at 10% penetration, that's 500,000, and so forth. It's very easy to calculate, but that's a rule of thumb, but it's easier to understand. I envision that demand's going to go well beyond the 500,000 and into the million ton per year demand. And that point is where you will see the price potentially skyrocket if supply doesn't meet that demand. Now, to your question about Corfo in Chile, the government in Chile has been controlling. In fact, at SQM and Albemarle rent their salar, and they have a rent right now until 2030. The government of Corfo finally came with an agreement with SQM saying that you can produce now up to, or you can apply for permits, not permits, you can apply for permits up to produce 2 million tons from here to 2030. That doesn't mean they have the permits to do so. And in order to produce that much money, they're going to have to invest a lot of money to produce that. They're going to do an environmental study. There's a lot of other technical aspects that people seem to forget. So the fact that these guys we're going to be able to produce 2 million tons over the next 10, 12 years is going to be very difficult. Very, very difficult.
Lastly, Carlos, let's look at the valuation of Neo Lithium. How do you think it stacks up to some of the peers? Are you being valued fairly by the market?
The short answer is no, and I'll explain why. I see the valuation two ways. I see a very crude metric, which is enterprise value to resource, and I see the valuation, the other one called price to NAV, or price to net asset value. On the enterprise value to resource, essentially, if you look at our enterprise value, today we're being valued around $1.80 per share. We have about 120 million shares, so that's roughly about 210 million Canadian market cap. If you deduct all our cash, which is about 60 million in cash, which is, we are one of the most well-funded companies out there, that gives us about 150 million of enterprise value. If you divide it by 3.5 million tons that we have, that's less than $50 per ton of resource. Our comps are being traded at $80 to $120 per ton with an average of almost about 100. So we're essentially half that on the enterprise to value. And that's not even saying we have higher grade and lower impurity. So we should be trading at a premium, not a discount. So that's on that front. On a P to NAV basis, we have a result from our PEA of a 1.2 billion US after tax 8%. That's about a 1.5 billion Canadian. And our, if you divide that by our share price, we're trading about 0.1, 0.2 times price to NAV. And everybody else is trading at 0.4 to 0.8 times price to NAV. So there, we're not only half, we're almost 3 times cheaper than anybody else on that front. We believe we're not being valued correctly. Now, it is our responsibility to make sure that the market understands why that is, and that's exactly what we're going to be doing this year. And as we de-risk the project over this year, we obviously hope that that gap will be smaller and smaller over time. So that's on the valuation front.
Most of the data that's ever been created has been created in the past 2 years. You need a system for analyzing and making sense out of that data, and that's what we do. Where we, I think, really shine is we're a turnkey solution. We have hardware products that we can put in place. We have telemetry that we can put in place. It's all cloud-based, and we do it all for you.
From the heart of the financial district in downtown Toronto, that's our show for this week. I'm Mark Bunting. Be sure to subscribe to our YouTube channel so you don't miss an episode. And for more great research and great investment ideas through our weekly digest and morning note, subscribe to capitalideasresearch.com. Thanks a lot for watching, and thanks for investing like a pro. We'll see you next time.